Thank you, and welcome to our 2022 annual results presentation. I am joined today with Lizzie Tan, our CFO and Joint Company Secretary. And I would like to just move to our disclaimer. So the first presentation point obviously is this is general advice in nature. We're not taking into account anyone's personal circumstances, and we're certainly not making any recommendation to buy or sell shares, just providing a general presentation. The agenda I have for today is to cover 5 basic areas. The first is I would look to obviously discuss the financial performance of 22 that we have just presented to the market. We're looking to provide the investors on the presentation today an update on our 7-year business plan that commenced in 2019 and runs through to year ending 2026. I'm looking to provide a divisional update in respect to the progress we've had on those ambitions and where we see the future, and also finally comment on the advice industry as a whole and the opportunities that we see as ahead. And probably the most important part of today's presentation is to take questions from shareholders that have an interest in us. I'd like to thank you for being shareholders, and whilst these presentations are good, I think it's the most important part of them is to give you the opportunity to ask questions of us directly and answer them in a public forum, which we're very happy to do. I'll just touch, before I pass to Lizzie, I'll just touch on the financial highlights from my perspective very quickly before she digs deeper into the numbers. The most important part for us is operating cash flow. So we're looking to build a business that generates cash, pays tax, and then distributes its cash flow into making further acquisitions and paying dividends. We'll talk later on the dividend policy, but from our perspective, we are very conservative on the way we account. We don't put any abnormals in. We don't try and make the EBITDA look better than it can be, because we're looking to pay as little tax as we have to. And the most important function from me as CEO is generating cash, using that cash to make further acquisitions and continually growing that operating cash flow. So the result today, I think, is very impressive when you consider where we've come from in 2019. Shareholders have generated 11 cents per share in operating cash before tax. And I think that's the most important number that we're wanting to share today. But I will now pass to Lizzie Tan to discuss the results in greater summary and talk about the revenue growth, EBITDA, operating cash flow, and our dividend policy. So thank you, Lizzie.
Thanks, Garry. Good afternoon, everyone. It's nice to see on slide 4, it is all positive news and a sea of green. Revenue and earnings have increased. The underlying profit increased 7% and NPATA 6%. So let me give you a bit more details. Our net profit after tax for the year is 5.7 million. This is a good result in what has been a challenging year. The aftermath of COVID and war in Ukraine have lifted interest rates and inflation rates. Labour shortages push up wages, low market confidence, and high market volatility. These reasons have made us review and update our 7-year business plan to reflect the current economic situation impacting our businesses. The Sequoia journey started in 2020. Back then, the board set core focus on 5 key initiatives, which we are fully committed to deliver on these promises. 2 of the key initiatives were to grow profits and increase dividend payout over time. Today, I'm happy to report that we have delivered on both these promises. Firstly, our NPAT of 5.7 million and our normalised EBITDA of 12.4 million. The underlying profit is the best earnings we reported so far. Secondly, we declare a final dividend of 0.9 cents per share, fully franked, which will be paid in early October. This brings the total dividend for the year to 1.4 cents per share, an increase of 40% from last year. Our revenue for the year grew to 147.3 million, up 26.5%. There are a few reasons for this increase. We've made meaningful acquisitions with strong EBITDA in the last 18 months, like Panther Corp and Tech Insurance Brokers. We also experienced full-year impact on various client books acquired, Again, positive EBITDA with limited revenue leakages. Our financial advisory business in the licensee services division have performed well. Commission revenue have increased 25% for the financial planning companies, and we continue to have recurring and growing revenue from our quality of advisors in these licenses. The equity markets division also performed reasonably well. Specialist investment team have earned better than expected performance fees on structured products. Morrison Securities also reported revenue growth in wholesale clearing and execution transactions by almost 20%. In the fourth quarter of 2022, Morrison nabbed the top 3 position in options volumes trading, maintaining 9% market share. It is inevitable in the current environment, OPEX have increased like most companies coming out of COVID. In the second half year, we incurred higher integration costs following the acquisition of Informed Investors Group of companies and the insurance brokers business. And we spent more on technology costs to enhance cybersecurity capability and technology upgrades. We also experienced some unexpected claims in the advisory business. Also, in the latter half, we made more strategic hires in sales, marketing and legal services and offered higher salaries to retain talents in our organization. We added almost 19 full-time equivalents this year, both employees and contractors. This is the company's investment for tomorrow. We realize that it is necessary to make strategic investments, knowing that this short-term pain would impede EBITDA growth and reduce EBITDA margin. However, it remains our commitment to improve EBITDA margin in the long run. Therefore, as a priority, we endeavor to streamline processes and undergo team restructures to reduce the group's cost base in the coming year. The good news is the company continues to generate and build on its cash reserve. Our cash balance at the end of the year was 14.9 million compared to 13.7 million last year. The company's operating net cash flow before tax also improved by 36% to 14.7 million. For this reason, we were able to use 5.9 million of this large operating cash flow generation to fund acquisitions and investments during the year. The cash conversion ratio to EBITDA remains relatively high at almost 1.2 multiple compared to 0.94 in 2021. We emphasize that the company can convert most of its EBITDA into cash. The high ratio is achieved by having good working capital management, limited capital expenditure, being debt-free, and having an effective and robust cost management process. Before I end, I want to bring your attention to slide 6, which basically provides a summary of financial highlights. Good earnings growth, a strong balance sheet, high operating cash flow to EBITDA ratio, almost 1-to-1, recurring and growing revenue, strategic investments for future. These are all the right elements to achieving our 7-year business plan. I reiterate that we are on the right path to creating more shareholder value for our investors. More importantly, by growing revenue, increase OPEX at a slower rate, and ultimately increase our underlying profit of EBITDA and net profit margins in the years ahead. With that, I shall pass on the mic to Garry, who will take you through the next slides.
Thank you, Lizzie. I'll move to the 7-year business plan, and we've made some changes in respect to some of the forecasts in respect to revenue and some of the forecasts in respect to margin. We've come to the belief that whilst our share price is soft, and I must say I'm extremely disappointed with it, we're undergoing a number of capital management strategies to improve that. But in understanding we are where we are, it's difficult for us to use our currency, being the script, to buy the type of acquisitions that we may have hoped for in the past. There's absolutely an opportunity for consolidation in the financial services licensee area, with obviously a number of listed companies and a number of unlisted companies that support the advisor networks across the country. But whilst we're trading on a multiple of less than 5 times operating cash flow, we're just not prepared to issue our currency, being the script, to acquire businesses that are being rated by the market on 10 to 12. So as a result of that, we've taken a little bit more conservative stance on the forecast. That is not saying we're not still very interested in acquisitions, but we're just taking a more conservative stance. And as we've done in all of the years as my CEO, we believe we're the tortoise, not the hare, and we're trying to be understating rather than overstating. And this talks to that. So our goal is to move from the current $147 million of revenue to $300 million of revenue, a 20% per annum growth. Of that, we are expecting 15% of that growth is completely organic. We would absolutely expect to do some acquisitions, but not the big ones that we had hoped that we may be able to buy if our shares were trading on a more meaningful cash flow to EBITDA multiple of sort of 8 to 10, which is where the rest of the market is. As a result of that, we're taking a more conservative stance on the forecast. However, we're taking a more aggressive stance on respect to our margin. The margins in the licensee services business and the margins in the equity markets business are very tight. We had hoped to get a 10% margin return, but they've been closer to 8.5%. Where the professional services businesses and the direct businesses have much higher margins. So our acquisition strategy in the short term is to continue to buy businesses like we have recently in the direct area, in the professional services area, like our insurance broking business, our documents business, our legal business, and continue to provide more services to those advisors who do business with us. We would think that the EBITDA and operating net cash flow before tax moves to about 1 time. So as Lizzie touched on before, in 2021, it was 0.92. In 2022, it moved to 1.19. Long term, we expect it to be 1. So every dollar of operating cash flow, we expect to move to EBITDA. We don't do any clever improving the EBITDA line. We expense everything, which includes writing down the value of investments that we hold that don't necessarily impact cash flow, and so on. So we're taking a conservative stance in there. But over that, by 2026, we would like to see your company with $300 million of revenue and generating $30 million of operating net cash flow before tax, paying something like $4 to $5 million in tax on that at the net profit before tax margin, and then having $25 million of cash to pay out at an increasing dividend payout ratio. So whilst our shares are soft, we're paying a 33% payout ratio. So we're going to be using that we've suspended the dividend reinvestment plan, hoping that those who do like to benefit from compounding, reinvest their dividend and buy some shares in the market. But we will also recommence our share buyback. We stopped the share buyback on the 30th of June when the company was aware of its upcoming results, and we felt that we were in a closed period. So that closed period ends in 3 days after the announcement of these results, and we'll be back in the market acquiring shares if the market allows us to do so at a value that we think is undervalued, as we currently do believe it to be the case. But over the next 4 years, we'll be going 40, 50, 60, 70% on the dividend. The licensee service division grew by 15% in revenue. We've got a number of businesses in that, the prime 2 businesses being Interprac Financial Planning, Libertas, and that's where most of our advisors sit. As most people on the call would be aware, the financial services industry has seen the number of advisors reduced from something like 25,000 to 15,000. At that time, where you're kicking absolutely into the wind, Sequoia has experienced 15% increase in revenue. Our numbers are about flat. However, we've lost the tail and we're absolutely winning market share at the premium end, and that's why our revenue was able to go up 15% in a market that's contracting. The opportunity in licensee services and advice has never been better. The demand for services from an advisor and the lack of advisors in the marketplace is really creating some significant opportunities for advisors, and we are being contacted on a regular basis for more advisors wanting to join us. Some of the less mature businesses that we've got in this area are our Sequoia Corporate Finance. We've invested heavily in that area this year. We've added 3 full-time staff. So as Lizzie pointed, we're paying it forward. The results might not necessarily be there today because we've invested for tomorrow. The Sequoia Family Office business that we commenced last year from a starting point of zero has generated some very positive results, particularly in the last quarter, and we expect that business to be a very meaningful contributor. The Sequoia Insurance Broking business was the acquisition of TAG Insurance Brokers. That business has doubled in the first 12 months of being with us. So we've really been able to integrate that business and also create a lot of new business opportunities by the dynamic that we have with multiple services and multiple offerings across the network being introduced to each other. And our Sequoia Wealth Management business, which is our brokers, we're actually starting to get a number of calls from brokers in the industry that are aware of our offering, and they're looking to move from completely transactional type broking businesses that they're currently at to a more business where they're looking to build ongoing income and offering multiple services. And that's what the Sequoia Wealth Management business offers. And we believe our Sydney and Melbourne office will see a number of new brokers joining our team in the next 3 to 6 months. The equity markets business is the Morrison's business, the Morrison's clearing business, and the Sequoia Specialist Investment business. Our Sequoia Specialist Investment business was pretty flat for the year, and that's where we want it to be. It's not a business that we're looking to grow. It's just a business we're looking to maintain and continue to offer investment opportunities to our client base over the long term. The performance of the underlying thematics have been very positive, and our team has done an exceptional job in seeking out opportunities for our professional investors and introducing to a variety of financial planning networks and clients of the group. Our Morrison business saw our clearing volumes increase by 60% over the 12 months, and we're continuing to win new clients from wholesale investment mandates and third-party AFSL holders. We would think that this particular business will move to 125 million of the 300 million revenue that I was talking about, and we'd look to move towards a 10% margin. The 9% EBITDA margin that we've generated in this business and 8.5% EBITDA margin that we've achieved in licensee services this year is somewhat disappointing. However, we've invested very, very heavily and expensed all of that in this financial year to benefit from the long term and move towards that tortoise and hare approach that I often talk about, where we invest today to get a long-term result. And I expect our EBITDA margins in licensee services and equity markets to move back up towards 10%. Examples of the investments that we've made, Lizzie touched on the 19 full-time staff, but we've also made investments in preparing ourselves for ASX blockchain, for example, fully expense those items, yet the ASX delayed that so far on a number of occasions, but it's hurt our short-term numbers, but we're in a position where we believe we're ready. We've invested heavily in cyber protection across the group. We've got a full-time cyber protection and IT specialist that's joined the group in this 12-month, fully expensed. So there's a number of those short-term pains that will create long-term gains and move the margin back up to where it should be in the two larger businesses at 10%. So the 125 million at 10% for licensee services by 2026 and 125 million at 10% in equity markets division. The next two divisions I want to talk to is where you can create much higher margins. And we are investing and we are on the acquisition trail, particularly in professional services in the next 12 months to 24 months, and was in the acquisition phase at the back end of this financial year where we made several acquisitions, the direct business, which are yet to hit the revenue line, but did hit the expense line. So again, short-term pain for long-term gain is the thinking in that respect. The professional services business itself increased by 55% in revenue. Whilst it did that, it also increased its EBITDA margin to a very healthy 26%. And that's where we are looking to expand and grow the opportunity. The licensee services business and the equity markets business creates opportunities for this particular division to introduce itself to clients of those groups and then provide services and support to help the industry reduce the cost of advice. So things like our document business, our self-managed super fund administration business in particular, and our legal services businesses have been taken up very well in the short period of some of their ownership, and we are seeing very, very strong growth in revenue, and we expect that to continue. We would expect $35 million of revenue in this particular business by 2026, so 3 times where it is currently, and we'd expect that margin to maintain at the 25 to 30% level. So much more attractive than the challenging wealth and licensee services businesses. The direct investment division, I made some commentary at the last year's results about a desire to expand this business. We have now done that, but unfortunately for this year's financial performance, we only did it in April and May, so we've had almost no revenue impact from the recent acquisitions, but we've had heavy cost of acquisition impact from those acquisitions. So in the short term, that's negatively impacted the EBITDA, and certainly the revenue number is nowhere near a level where we wish this division to head towards. But we would like this division to be 5 times to 6 times its current level at the type of EBITDA margins of 30% plus that this particular area of the business creates. It's a very important area of our business because it creates enormous opportunity for the retail client, enormous opportunity for the financial planner, the stockbroker, and all the clients we serve, in that it provides education, it provides news, it provides research, and all the types of things that people are looking to receive when they're making financial decisions, not just the financial planner, but also direct investors, fund managers, and the like. And this particular area of business is a little understated at $2.6 million of revenue and EBITDA margin of 37% and just $1 million of EBITDA. But it is very important that it's definitely a key part of our future thinking, and one would expect this to make a more meaningful contribution. 15 million at 30% starts to really move the dial for that particular business for us. Lizzie touched on before a little bit about the difficult conditions and the opportunities for the advice industry. So inflation, rising interest rates, COVID, global tension, all created volatility for investment returns. We wrote down the value of some of the investments we hold by $700,000 opposed to a $500,000 positive contribution the year before, so a $1.2 million swing in EBITDA. In that respect, obviously it doesn't have any change on cash flow because we haven't sold those investments, but we've held some listed investment companies, and we've also held some investments in other listed companies that are in our industry that we might have interest in the future. So we're sitting on some investments that may be part of a consolidation play or may be part of a potential acquisition in the future, that we've had to write down the value of those shares as they fell. But certainly, as far as a cash flow point of view, they haven't impacted us. We've invested heavily on compliance. We've invested in technology that allows us to look at advisors' advice documents from by using words and robo and those types of investments, and that's seen other licensees come to Sequoia wanting us to support them in respect to some of their compliance oversight. But those investments are expensive, and those investments are really, as I said before, paying it ahead for tomorrow. And whilst you may look at the short-term EBITDA number and be a little bit disappointed, we think they will pay off in the long term. So, despite the headwinds, I really think that the business is placed far better than it has ever been placed. The demand for outsourcing and the demand for the one-stop shop opportunity that we can provide licensees, our own advisors, but the broader market, I think, is continuing to grow and is very large. Just in finishing, before I move to questions, which I think is the most important, the question is, who do we serve and why do we serve? So there's 15,000 financial advisors under approximately 2,000 AFSL licenses in Australia. There's absolutely no reason why Sequoia cannot provide a service to every single one of those. The industry tends to talk about us as a licensee. We are not a licensee. That is one of the 20 businesses that we provide services to. But the opportunity is for us to provide a service to every financial advisor and every AFSL license who might need one of the solutions that we provide. And I really think that's important to understand. The second area of opportunity for Sequoia is that we're providing services to accountancy practices and law firms across Australia. There's currently around about 10,000 individual accountancy practices across Australia. We're having relationships already with about 3,000 of them. But at present, we're a bit like the big old house where we've got all the rooms and we've got the kitchen and all those sorts of things. But we just need to tidy up the wiring and maybe do a few renovations and start to cross-market our business a little bit better and introduce all of the services that we actually provide to all of the people we currently do business with. And that will create a very large opportunity for growth in particularly professional services and the direct business that we offer that's not necessarily reflected in the current numbers. Not that I'm suggesting 11 cents per share operating cash flow is not a good result. I think it's an excellent result. However, I think that the opportunity for much more meaningful numbers over the long term, because of the past investment and the investment we've made in this particular year, will pay long-term dividends. Australians have approximately $14 trillion of private wealth, with 6.6 trillion of that wealth invested in managed funds. Our direct business with businesses like Informed Investor, in particular Corporate Connect, have got a real opportunity to educate the market in respect to all of the managed investments out there so that financial planners and the general public can have a source of truth, impartial, that allows them to make informed decisions about the $6.6 trillion of wealth that they actually have sitting in such investments. The last type of client that we have is the fund manager themselves, the listed company themselves, looking to have exposure to our media business, our financial planners, and those who might be interested in having a look at their company for a personal investment themselves, and someone who's looking to work with someone with impartial advisor distribution. So we are not going to go into manufacturing product. The Royal Commission talked about this 3 or 4 years ago. There seems to be a pushback in some circles towards product managers having licensees. We are not going down to that track. We absolutely believe that the opportunity in the advice market is to be impartial to product and talk about offering multiple services to their client base and offering advice. I might just finish there. Thank you. And if there's any questions that you've been sending in, Steve will ask those of Lizzie or I. But thank you for your patience and thank you for your support so far.
Thanks, Garry. I encourage anyone who has questions to use the chat function to send them through. But we do have some questions for the moment, Garry. I might start with Lizzie, if that's okay.
Yep.
So why was the cash flow from operations 119% and well above EBITDA? And why do you expect this to normalise to 100% by about 2026?
Well, historically in the last 3 years, the ratio cash to EBITDA sort of fluctuates, but it's still an average of 1. So we're just making the assumption that that will be the case going forward. Hence, EBITDA will be 1 to cash, basically EBITDA and cash.
Okay, yep. Fantastic. Thank you, Garry. You mentioned you provide services to accountants and financial planners of the financial planning licenses.
Yes.
But to other advisors and accountants out there, can you provide a real example of how you do this?
Yeah, I can do that. Let me think. There's probably a couple of ways to answer that question. Maybe I might touch on just an example client. That's probably the best way. So let's suggest a 45-year-old married guy comes into our office who has an own business, and they're either looking to engage a financial planner or work with their accountant for the next 15 or 20 years. So if you look at our offerings, that person might want to set up a structure, for example, that their assets might be best held in a family trust. Their assets might best be held in self-managed super fund, they may consider using a company. So our documents business creates an opportunity to provide a service to that 45-year-old. The second is if they do that, they'll need some administration. So if they've got a self-managed super fund and they're engaging with a financial planner and accountant, to reduce the cost of the advice and reduce the cost of the structure, they need a self-managed super fund administration service that is low cost and provides both the planner, the accountant and themselves value for money. So we have that opportunity. Obviously, they could need advice, so that they might want to actually then select where to invest their money, and that's where one of our licensed financial planners may have the opportunity to provide them that advice. Because we do clearing and stockbroking, again, that particular client, rather than going through one of the platforms for their share trading component, their advisor or their accountant might use Morrison's, set them up with an account and be able to reduce the cost of their trading. They're the sort of things, our specialist investment from time to time, if they're a sophisticated nature or they'd like to generate a particular thematic, they might want to invest in high yield, or they might want to invest in a thematic such as lithium and batteries or the next generation of investment. They might have the opportunity to talk to our specialist investment type person. And probably the missing piece that in our numbers, and they're very low, is the direct division. We're researching all of the managed funds. We have all of the PDSs of all the managed funds on our Informed Investor website. So again, there's an opportunity for that 45-year-old to get access impartially, whether they go through one of our advisors or just direct go onto our website and have a look at the thousands of managed funds that provide services, so their past returns, their MERs, their thematic, watch a video on the manager, and just get a feel for the type of clients. And long-winded question, long-winded answer, I'm sorry, but we probably provide a dozen things to that 45-year-old where one of our licensees or one of our accountants or one of our financial planners or themselves has an opportunity for us to get a share of wallet. And as I touched on before, the old house with all the things, that's what we are. We just have to begin to get the market to better understand that we're not just a licensee business, we're actually a full service offering with everything a financial planner, accountant or a self-directed investor might want to have access to. I hope that's not too long an answer for the person that answered that question, asked that question.
That's fine. Thanks, Garry. So in the 2026 numbers, you mentioned revenue might hit 300 million and 300 million of operating cash flow in EBITDA. Is this suggesting 10% is the ideal margin, or is this dependent on acquisition and margin improvements? I know you might have touched on this, but do you mind going through that again?
Yep. So it's actually not the ideal margin. So 300 million at 10% is the 30 million, as the question asked about. But as I pointed out before, 250 million of that is looking to get to move our current margin of 8.5% towards 10%. However, the 50 million being the direct component and the professional services component, I'm looking to be at a much higher margin. So in the ideal world, a 10% group margin is the tortoise. It's not the hare. But if our revenues were to be more tilted towards where they currently are, which is in licensee services and in equity markets, and we do maintain that 10%, that's the sort of return I would expect on revenue. However, as the business grows and we invest more in those other areas of the business and we integrate them, I think the opportunity is actually for a better margin than 10%. But I'm just trying to be conservative in those numbers and downsell a little bit the revenue growth that we may have talked about, hopefully getting towards 400 million previously through acquisition and having a less aggressive acquisition strategy in the licensee services area, whilst those businesses are selling for 10 to 12 times cash flow and we're trading at 4 to 5.
Okay, great. With the advisor numbers across the industry falling, how do you see Sequoia placed where the licensee services revenue can effectively double every 4 years as they have in the past 4 years?
Yep. So our numbers over the last 12 months were flat in respect to actual advisor numbers. But as I touched on before, each advisor that we've got is of a higher and higher quality. So there's been 25,000 advisors down to 16,000 advisors across the industry. That's a huge drop. But those advisors that have exited are probably, not in all cases, but in some cases, the ones that should have exited. They're not actually operating a business. They probably didn't provide as much value to the end client as they could have. But those that remain and those that are beginning to come through the industry under professional years and are consolidating are generating more and more revenue. So I would think that our revenue will continue to grow in that particular area of the business from more advisors, but more importantly, from each of the current advisors that we've currently got doing more business and being more profitable, and therefore us getting a greater share of wallet in respect to their licensee services fee. And we're seeing that. The demand for advice is increasing dramatically. The cost or the charge that the advisors are charging to the client is increasing because the value they provide and the lack of competition for that quality advice has shifted. And groups like us and a number of other groups are in a really strong position. So whilst we were kicking into a very strong headwind the last 3 years, it's actually turned. And the future looks extremely bright because the demand is absolutely going to be far greater than supply.
Great. We've got more questions coming through. So it appears equity markets have slowed significantly in the second half, probably understandable in a risk-off environment. But can you drill down some more? Is it clearing volumes or the number of large deals being done? And were equity markets over-earning in calendar year 21, or are they under-earning now, or is it both?
It's probably because the earnings are a little bit distorted in that you've got equity markets is made up of two prime businesses, Morrison's business and our Sequoia specialist investment business. Over the sort of 12 to 18 months, the contribution we received from the specialist investment businesses when markets were very strong and demand for those types of investment was strong was far greater. So we've had a reduction in the revenue line and the profit line in those investments in that 6 months period. However, on the other side, the Morrison's business itself is growing really strongly, but the margins there are very low. But we are winning market share in the Morrison's business. So I definitely expect the Morrison's business to continue to grow. We're winning new clients all the time, but I think the SSI or the special investment business is likely to stay flat. But I'm very confident the numbers I projected that we will get to $125 million in that particular business at a margin of 10%. We've invested really heavily in infrastructure, and we've invested really heavily in people, and now's the time to get the return on those investments, and we do expect to get those.
Great. Probably got one more. So margins appear to improve in most divisions, not the direct investments, in the second half of the year versus first half, despite making investments. Can you speak a bit more to this?
I think I might pass that to Lizzie because she's the champion of cost control.
This is.
Yeah, I think Garry's touched on a little bit earlier on the margins. I guess basically the licensee services business and the equities markets, the volumes are large, but the margin it's not as high as we expect. They are all below 10%. But the volume is high. So we are definitely working on improving those margins, but it's just part of, in the last 12 months, we had to make some investments in the year. And also, so hence that sort of have a short-term impact to the margins. On the other side, where the professional services and direct investment services, historically, the last 2 years, I think the margins for those businesses have been quite good, but we need to invest more on sales to bring that, to be able to invest more on those businesses, given that it has really good returns. Yeah, I don't know if that answers the questions.
Okay.
Yeah.
Thanks, Lizzie. That's all we've got at the moment. Gary, we might leave it there. If
Yeah,
there's
no, thank you.
more to add.
Yeah, no, I'll just add a couple of things. I'd like to thank a few people. I'd like to thank our staff. It's been, COVID, inflation, working from home, the environment, all those sorts of things have been really challenging 12 months. And I'd like to thank all of our staff, all of our advisors, all of our clients for the support that they've given us and the ability to increase our revenue at a time where many are not, and also increase our cash flow from operations. We've had a really dedicated group of staff. I also like to thank the long-term shareholders. One of the negatives associated with Sequoia brand a little bit is that our shares don't trade very much, and one of the reasons for that is because we've got a really loyal shareholder base, and I think most of them believe in the 3 and 4 and 5 year story where we're trying to build. In some ways, we're almost like a private company that's trading on the ASX with a lot of long-term thinking, and I appreciate that. Having to achieve short-term results on a monthly business like a mining company might have to do in a financial services business like ours is challenging, and I think the only way you can win and be the champion of the industry is to take a long-term mindset. And most of our shareholder base have done that, and I'd really like to thank them for that. And also like to thank the advisors that we've got in our business in particular. They've gone through challenging times. Royal Commission 2018, gone out and become educated. We only have 2 advisors left that have to. Well, they've sat the test, they've sat the exam that's coming up for October results. So, the industry's likely to see another 1,000 to 1,500 advisors drop off at the return of the October exams. Sequoia and Interprac, Libertas, Sequoia Wealth Management advisors, we're not in that position. Our guys are already through. They're looking at their degree qualifications. They're bringing in business planning experts. They're working closely with our practice management team, led by some terrific people. And, I think they've done the hard yards and invested in themselves and their family and their clients for the long-term future because, as I put it to many people, the most important investment any Australian can make is to engage with a financial planner. And there is not enough of them. We're lucky to have a lot of them. And I'd like to thank those that we have for making the commitment to their education, the industry, and making it a better place for Australians seeking advice. Thank you for your time, and thank you for being a shareholder.